If you've been following the news lately, you might have noticed that there seems to be a lot of mixed messages about the state of the property market. While some commentators are still warning about a looming property market crash, due to rising interest rates, the statistics that came out at the beginning of the month from all the major property research houses suggest our property markets are looking for a floor. Of course, this is not unusual. During the boom times, the media is very positive. During the slump phase of the cycle, all the media messages are negative. But as we move into the next phase of the property cycle, it's normal to get mixed messages in the media. Some commentators are ahead of the pack, while others are still looking in the rear vision mirror at out-of-date data. That's why I enjoy these monthly big picture podcasts with Pete Wargent, who brings years of perspective to his commentary. In today's chat, we're going to discuss the market outlook for the Australian economy and our property markets, and some of the latest economic figures that came out about housing, CPI, and what about those bank failures overseas? What are they going to do to our markets? So join me and Pete, and let's explore the big picture.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
In these regular Big Picture podcasts, Pete Wargent and I discuss the macroeconomic factors affecting our economy and our property markets. But before we get into the big picture, today I'd like to have a chat with Pete about what's happened to our property markets 3 years on from the beginning of the pandemic. Now, regular listeners will know Pete well, but if you're new to this podcast, well, firstly, welcome. And you're soon going to see the reason I love having these discussions with Pete, because it's not because of his academic credentials as a chartered accountant, chartered secretary, or because he's got a financial planning diploma, but because he brings a credible perspective to the markets, being an international investor and business person. Welcome, Pete.
Hello, Michael. Great to be on, as always.
Well, interestingly, just before we pressed the record button, we had to talk about what's happened over the last 3 years, because I was in Melbourne, you were in Queensland and overseas for much of COVID, so it was very different. But really now is almost anniversary of our first lockdown. On the 11th of March 2020, the World Health Organization declared a global pandemic. And at the end of March, Melbourne went into its first of 5 lockdowns, but that was because we had 20 cases of COVID, and that first lockdown was 45 days. Well, the crisis in health had little direct implication on the housing market, but boy, were there some unusual, unexpected consequences. That unprecedented expansionary fiscal and monetary policy, and now the tightening, has really made our markets go up and now down. The border closures affect them. So let's have a look and see what happened. Pete, firstly, despite all the negative talk about our property markets at the moment, housing values are overall 14.8% higher, according to CoreLogic, than where they were 3 years ago in March 2020.
Yeah, it's been a funny few years, hasn't it? There was the post-election boom in 2019, which was going gangbusters, and then, as you mentioned, first quarter of 2020, a huge amount of uncertainty at that point in time. Prices started falling a little bit, particularly in Sydney and Melbourne. Then we got the reopening and then another kind of surge. So we've gone through these ups and downs. There's been a few sort of waves since 2019, but overall since that time, prices quite significantly higher. So I guess if you were an investor in 2019, you'd be pretty happy about that, despite the ups and downs along the way.
Very much so. And there were fragmented markets. So even during that once-in-a-generation boom when almost every property went up in value, houses did better than apartments, and regional markets outperformed. But this seems to be reversing now, Pete.
Yes, that's right. So we did see that rush to the regions in 2020, which is, I guess, a rational response. The offices were closed. People wanted fresh air and more space. But actually now we're seeing that go back the other way. So if you look at where rental vacancies are rising, don't forget this dwelling construction cycle has got a very long tail on it. Lots of houses still being delivered to the market. Well, vacancies are rising in Hobart, Gold Coast, down your way, Mornington Peninsula, Blue Mountains, but also in some of the other capital cities like Canberra and Darwin. The tightness in the rental markets that we keep reading about, well, that's largely now focused on particularly Melbourne and Brisbane and Sydney. So international students are coming back, but also some of those people who went out to the regions for a year or two starting to flock back to the cities, partly because employers want them back in the office at least 2 or 3 days a week.
Well, in line with the increased demand from students, from people now moving back to the city, there's actually a lack of supply. Firstly, a lack of apartments coming out of the ground, but in the last 5 months, 1/3 of all properties currently listed for sale were on the rental market. Before. A couple of weeks ago, PropTrack, which is owned by realestate.com, said very similar figures. They found that on realestate.com, properties currently listed for sale were on the rental market before. That's cutting out a huge pool of properties, which is only going to make the market even worse.
Yes, and it's being reflected largely at the moment in rising rents. So don't forget when new arrivals come into the country, and we saw a record high permanent and long-term arrivals right at the start of this year. Well, most new people who arrive in the country are renters, and that's happening at a time when quite a lot of landlords have sold up through the pandemic. A few more have been discouraged by changes to things like tenancy rules, also the rising interest rates for investors. Well, if you look at the rents index for the last 3 months, asking rents for Sydney and Melbourne are up nearly 9%. It's absolutely booming. Over the year, about 25%. So these are the seeds of the next boom. It's an undersupply of housing, and especially at the moment, rental housing. So there's a real rental crisis, and it's focused on certain parts of the country. We're seeing a lot of, there's rising homelessness. We've got people camping out. There's the real crisis underway, but it's not actually all around the country. It's just focused on certain areas.
That's right. And while the apartment markets underperformed during the difficult years of the pandemic, they're now falling into favour. I guess it's partly affordability. If people want to live in those great lifestyle suburbs of our big capital cities, but they can't afford a home or a terrace, they're moving to nicer, bigger apartments.
Yeah, I think this is why they say that the bottom of the market is normally a process, not an event. I think 2019 was really unusual because we got favourable election result, then the Banking Royal Commission wound up and that was a bit of a nothing burger. Then we got an interest rate cut all in the space of a week, and we got this really rapid V-shaped recovery rocket. Well, normally that's not how a market bottoms out, and I think that's what we're seeing right now. Some parts of the market, as you mentioned, are doing well. It's a bit fragmented though. I think compromised properties are struggling still a little bit with rising mortgage rates, but actually if you've got A-grade stock, as you mentioned, the sort of A-grade apartment is doing very well with downsizers and some investors. I think some of the family-friendly housing in the suburbs is doing really well, lots of active bidding, but there are some properties that are still struggling, and I think they'll probably continue for a while yet.
Well, there's probably going to be another interest rate rise sometime, maybe not, but I think people are now taking that in their stride and getting into the market. And there are some suggestions that the market is looking for a floor. In the month of March, CoreLogic have reported that in particular the Sydney property market has started to creep up just a little bit in value. Overall auction clearance rates have started the year strongly. So I'm not suggesting the market isn't going to fall a little bit further, but it seems to be looking for a floor. I can't see unless something out of the blue happens or the Reserve Bank goes a bit silly with interest rate rises, I can't see significant further falls.
No, so I think this is partly a liquidity thing. There's very few forced sellers in the market at the moment. We've got still very low unemployment, lowest in about 50 years or so. And we've got rents rising very quickly for landlords. Just a few people at the margin, as you said, some investors have chosen to sell, but there's just not that much stock on the market. So that's just created a bit of pressure on some properties, and prices have just started to lift a little bit, especially in Sydney and to some extent Melbourne and Brisbane. I think, as you said, a lot really now depends on interest rates, huge amount of volatility in bond markets over the past week or so. A few banks have gone down in the US, most notably Silicon Valley Bank. And actually, if you look at, as we sit here today, markets aren't expecting any further interest rate increases in Australia and potentially even cuts later in the year. But it's very fast moving at the moment, so we'll just have to wait and see what the next week or two brings.
Well, I don't think anyone was surprised with the Reserve Bank's decision to raise interest rates in March, but the Reserve Bank governor came out suggesting that a pause in interest rates could happen, but they were going to be looking at 4 different factors. And while that was what I was going to talk with you about when I first thought, hey, we're going to have a regular podcast, over the last little while, there have been a number of overseas banks that have gone broke in the United States. Now, I loved Peter Switzer's commentary on the Silicon Valley Bank crash. He basically said the word silly and con are not inappropriate when you look at the way the bank operated. So what created that bank crash overseas?
Well, Silicon Valley Bank, I suppose, we don't want to be guilty of Monday morning quarterbacking, but obviously with the benefit of hindsight, there was some very poor risk management going on there and major liquidity issues as depositors started withdrawing funds. And there was effectively an old-fashioned run on the bank, but they just didn't have the liquidity to meet the deposit withdrawals. And yes, everything ended very quickly there. I mean, there were signals in hindsight, the market was beginning to price the risk. I think the big question when all this happens is those depositors may well be made whole with insurance and bailouts and so on. But what people start to worry about is, well, is this going to have a knock-on effect to other banks? So if you look at this morning's headlines as we record today, all about Credit Suisse, stock price down another 25%, down about 96, 97% from the highs of years ago. So there's a lot of worry now in Europe about people withdrawing deposits. So we're going to see bank runs in Europe. So all of these jitters are what has changed the outlook over the past week or so. For Australia, our key sort of benchmark yield is the 3-year government bond. Has a lot of impact on the housing market, in particularly fixed mortgage rates and so on. Well, we were at 3.7% only a little while ago. Now we're done at sort of 2.8. So it's a huge drop, massive drop. And that will actually have an impact on the rates at which we can borrow. So it has an impact directly on the housing market. I guess what everyone's worried about, well, what's going to happen to banks around the world? Is there going to be more uncertainty, more runs on banks?
Well, let's break that down a little bit, because first of all, your comment about bonds, what you're suggesting then is that the market believes that the interest rates in 3 years' time, if we're looking at 3-year bonds, are going to be lower than they are today, considerably lower. In other words, that it's likely that we've already reached the peak in interest rates and they're going to go down. And that will reflect in the Reserve Bank's official interest rates, which is then going to reflect in the interest rates that the commercial banks charge you and me for our mortgages. Is that what you're saying?
Yes, that's right. So as we see here today, the financial markets are expecting no further increases in Australia. Now, the RBA Governor, Philip Lowe, did say they'll be watching very closely to see what's happening in the jobs market, because the last 2 months have sort of seen jobs falling. But there was a suggestion that there was something like 100,000 people or so in January waiting to start new jobs. So we should expect to see a rebound in February. But there's so much volatility and seasonal factors. I think everyone's just waiting to see. I think the RBA would love to pause and just take stock of the situation, but the big part of their mandate is controlling inflation. So they'll be watching very closely just over the next couple of weeks. I think they would love to pause, though, and just let the interest rate rises that we've seen already take their effect.
Well, they want to see how it's working. They're also looking to see not just unemployment, but how business conditions are going and the inflation figures. And while the monthly inflation figures are coming out, they're not a very accurate indication of what's going on. From what I understand, Pete, they're only looking at about 60% of the basket that's looked at in the quarterly figures. So we've got to wait for the next quarterly figures to come out, which again are backward looking.
Yeah, that's right. So the monthly indicators, well, the RBA does watch them closely. But as you say, they don't capture all of the prices for consumers in the economy. And I think what we'll probably see when the first quarter inflation figures are out is that they're still above target, but probably not quite as hot as they were last year. So coming down, but probably quite gradually. I think we've probably passed the peak for inflation. And we're starting to see things like oil prices now back to 2021 levels, and some of the pressures on things like building materials are definitely coming off. So I think there are good signs there, but it's going to take some time before we get down to that 2 to 3% target range, of course.
Sure. Well, the Reserve Bank suggested that wasn't going to happen till 2025. And if they're going to allow that to happen slowly, that means that they don't have to keep pushing up interest rates. Now, the second point you made a moment ago is what's going to happen to banks overseas and here. Recently, Treasurer Jim Chalmers downplayed the concerns of potential implications of the overseas bank collapses with Australian banks. He said the federal government, Treasury and the regulators have closely monitored the situation and the impact on the Australian financial system. We have a number of supports that are going to make it much less likely to have a run on the banks or problems. Pete, I was in Australia before you in the early 90s when a number of the banks went broke. The State Bank of Victoria, the Bank of Adelaide, they took on difficult loans and it came to bite them in the backside. But it's unlikely we're going to have a crisis in our banking systems here.
Yeah, I think since 2009, Australia has gone through a process of trying to increase bank buffers so that we can be counter-cyclically strong, trying to remove risk from the market. But I guess the one thing with Australia, we've got a very different banking setup. And the one point that people always raise is, well, we've got a big share of bank loans in the mortgage market. So I often say in Australia, the housing cycle is the business cycle to some degree. So I think that if there is any risk for banks, it lies in housing. So paradoxically, that's why monetary policy makers and the regulator are so keen to watch the housing market, because that's where, if there is risk, it's all in mortgages. Yeah, so I guess the housing market has been in a downturn. Policymakers watching that very closely. But it's a very different dynamic from what we saw in, say, Silicon Valley Bank, where there was lots of money tied up in treasuries and then the depositors withdrew 42 billion in a day. It's a different setup. The risk in Australia is all in mortgages, and that's why we watch the market so closely.
Well, if we're talking the big picture, as we do once a month in these podcasts, if we look forward to what's going to happen to the Australian economy, clearly the Reserve Bank is trying to slow things down and our economy is going to slow down, but unlikely to fall into recession. Recently, our Prime Minister was in India, and I know he went to the cricket. I know that's one of the things you enjoy as well. But he's actually trying to increase trade with India, and especially the educational side of things. Obviously, it's an alternative to China amidst our interesting, souring relationships, maybe related to the submarines.
Yeah, so yes, on your first point regarding recession, I think if you look across the Tasman, I think New Zealand is probably already in a recession. They had some chronic problems with building materials shortages and other shortages with the closed borders. They had to take the official cash rate in New Zealand close to 5%. So that's really killed the economy stone dead there. Australia, I think, is a slightly different dynamic. I mean, at the moment, this ties back to your other point. Population growth is running at about 500,000 per annum. Pretty hard for an economy to go backwards when you're running such a massive immigration program. So look, we may see a slowdown, and we probably should see a slowdown in the economy in the second half of the year, but it won't go backwards, except potentially in per capita terms. Yes, the other part to that is immigration and the changing components of immigration. India, I think, going forward will be the largest source of permanent and long-term migration to Australia. It's been competing with China for a long time now, but I guess with all the issues going on globally, geopolitical strains and stresses, I think Australia is just diversifying away from China a bit, building a very strong relationship with India, recognition of Indian qualifications, fast track of student visa applications. So this is only going to further accelerate, I think, some of the very fast immigration that we're seeing at the moment.
Sure. And the old story we discussed a moment ago, where are they all going to live? Having said that, there are a number of factors that are going to keep driving our economy. And even though it's slowing down, the economy's growth means that we're going to still have a very low unemployment rate, even though that may creep up a bit, which basically means that our housing market's going to be supported by the fact that even though interest rates have gone up, people can afford to pay their mortgage. And despite the concerns by some people about how much debt we've taken on, the default rate or the loans that are in arrears is still very low, isn't it?
Yes, I think just towards the end of 2022, we just started to see the first signs of 30-day arrears rising. But don't forget, they're coming from all-time lows. We effectively had a moratorium on mortgage stress over the past couple of years. People took mortgage holidays. I think now, as some of those fixed-rate mortgages start to reset, we'll start to see rising arrears, but they're coming off the lowest level in history. So, of course, they're going to rise. Obviously, banks are watching that very closely. They're quite keen these days to work with stressed borrowers. There's very little incentive to foreclose on property we're seeing these days. They'd much rather work with stressed borrowers and either give them a mortgage holiday or potentially put them on interest-only terms, because we don't have many interest-only mortgages these days. So, yes, arrears are rising, and they probably will continue to rise this year, but from very low levels.
And that doesn't mean there's going to be a whole lot of mortgagee sales, as you said. So either interest-only loans, or they may extend the term of the loans. And we know that with finance approvals that are reported each month by the Australian Bureau of Statistics, a lot of people are currently refinancing, and banks are giving you an incentive to do that. So I think some people are getting ahead of this so-called cliff, which may only be a step or two down rather than a cliff we're going to fall over.
Yeah, of course. There's always an issue where people get used to living a certain lifestyle, and then it's hard to adjust when mortgage rates go up. But it's not like it's an unknown issue. We've been talking about this for months and months now, and it's not really a cliff per se. It's a step change in the market from record low mortgage rates. But overall, anyway, there's a job for everyone who wants one at the time being. Most landlords are in pretty good shape with rents going up, record low rental vacancies. So, yeah, of course, there'll be some stress, but at the moment, there's nothing systemic there.
Well, one of the things I know you report on regularly in your blogs, and I get that every day, and I'm going to leave a link in the show note for people to be able to get your daily musings as well. But we look at home loan commitments, because housing finance approvals are a leading indicator. If people get a loan or pre-approval today, many of them go ahead and buy something down the track, and they've been falling recently. And I guess it's also a little bit hidden by the fact that home loans are higher than to buy a home, it costs more than it did 3 years ago, as we said at the beginning of the show. But overall, investors are stepping out of the market, owner-occupiers are stepping out of the market, but refinancing approvals remain pretty high.
Yeah, I like a lot of these graphs and charts. If you look at them, it's been a very unusual few years. Initially, everything fell with the lockdowns, then we saw them rocketing back, and housing approvals or finance approvals were no different, and now they're just coming back towards average. So it's making a kind of tick shape on the chart. We're seeing that in all kinds of different data. Look, yeah, they're definitely slowed down. There's less activity in the market at the moment. So new home sales are at 15-year lows. There's not as many investors active at the moment, which is causing the rental shortage, of course. And there's just not as much property transacting at the moment. So there is still a healthy level of lending, but it's just way down on what it was. So I think we'll start to see this bottoming out fairly soon. I think borrowing capacities for some borrowers have dropped quite significantly from where they were anyway, but not every borrower uses their maximum borrowing capacity, so it won't have quite as big an impact as people think.
Sure, but the media loves saying that it's the 12th consecutive month in decline in home loan lending, the lowest since October 2020. But if you look at those interesting charts, it's still the levels of borrowings are way above where they were a decade ago or even before COVID. But a lot of this has to do with consumer confidence. So all these things lumped together affect how we as people feel, what we think is going on, and so therefore we make our decisions based on our job security, our financial security, and the continual negative messages in the media now worries about banks and overseas issues. It's brought our consumer confidence down to, or it's kept it down at very low levels, Pete.
Yes, yeah, that's right. In fact, consumer confidence, quite remarkably, if you aggregate all of the surveys, look, they're as low as we've seen since the global financial crisis, even lower than when we had all those lockdowns. Yeah, sometimes there is a bit of a disconnect between what people say and what they do. I think the thing to remember for people who are thinking of making an investment is these charts are kind of a contra-indicator, if you like, because the darkest hour is always before the dawn. And actually, if you were an investor at the lowest point of consumer confidence, you'll have done really well in things like the housing market and to some degree in consumer discretionary stocks and so on. So, yes, very low consumer confidence because of the uncertainty. But it will start to bounce once the interest rates peak, I guess. And generally, yes, you actually want to buy when confidence is low. It's not quite what you'd expect.
Well, it's a lot to do with the media, the 24-hour news cycle, who've got to come up with new things to say every day. It's really hard to fill it, the media, the online media with it. During the booms, everyone was positive. During the slump phase of the cycle, there was all the negative messages. But I can see now as we're moving into the next phase of the cycle, we're getting these mixed messages, some positive, some negative. And that's normal at this stage of the cycle. And when all the messages are positive, Pete, we're going to be so far past the bottom that people are going to have missed out. So I know your message to your clients and mine is similar. Don't pay too much attention to where we are in the cycle. If the timing is right for you financially, when you look back in a couple of years' time, probably when you look back in a year's time, you're going to be happy you made a property decision, whether it's a home or an investment. Yeah,
you just got to be really, as always, careful about what you buy and where you buy, and also the price you pay. There's been a lot of advice, in inverted commas, on the internet over the last 6 or 7 years, people calling peaks and troughs and all the rest of it. But actually, despite all the ups and downs in media commentary, prices have generally done pretty well over that sort of timeline. So you need to think carefully about what you buy and where. And also the price you pay. Yeah, I think we'll probably find that in the next few months we start seeing headlines about prices actually rising, and that just switches the sentiment in the market around. I think the big picture, and that's I guess in the end, the name of the podcast is that we've just got a massive shortage of housing for the next decade. Maybe in 3 or 4 years' time, we'll start to see build-to-rent towers sort of coming into the market, but at the moment we just don't have enough housing, and that's really what's going to sow the seeds of the next upcycle.
It's always related to supply and demand. By the way, I'm not suggesting there's a boom ahead, and I don't think you are either. As we move to the next stage of the cycle, as confidence returns, sellers are going to come into the market, more properties are going to be there, buyers are going to come in. So the shortage will settle down, and so therefore there'll be a stabilisation phase for a while. But certain properties in certain locations are always going to be in strong demand, and I guess we've got some fragmented markets ahead of us.
Yeah, that's exactly right. And I think that's the thing to remember. The bottom of the market is not an event, it's a process. Even when the Reserve Bank stops hiking interest rates, there's still quite a lot of fixed rate mortgages to reset. While some borrowers will be doing it tough, others will be looking ahead to the next cycle. Some people will be forced sellers, others will be picking up bargains. And that's how the cycle turns. It doesn't just happen on a single day or at a single moment. It's actually a process of some people selling at the lows and other people picking up bargains.
Having said that, we've noticed in the past that consumer confidence does change pretty quickly. I don't think it's going to be the same this time around. Remember 2019 after the election, how quickly the consumer confidence changed. You could see that instantly in auction clearance rates, what's happened on a Saturday. That happened a bit in 2020 after the first shocks of COVID. But I think this time around, as you say, it'll be more a slow process. And if you're in it for the long term, as you should be, whether you're a property investor or a home buyer, this is all very interesting, and we're going to come back once a month and talk about this. But to take advantage of the markets, you've actually got to be in there. So this month, I guess the big news was interest rates and the banks overseas. Who knows what we're going to talk about next month, but I look forward to catching up with you then. And between now and then, if people want to get your daily commentary, where should they look for you, Pete?
Easiest place to find me, my daily blog, Pete Wargent Blogspot, and if not, at Pete Wargent on Twitter, where I'm usually active most days.
most days.
Too much.
You're one of the most active, but you actually are a great curator of news as well. So if people follow you on Twitter, they can actually get information from a lot of other people as well. I'll leave a link in the show notes for both of those things, Pete. Look forward to catching up with you in a month.
Pleasure. Thanks, Michael.
In a moment, I'm going to be sharing my regular mindset message with you. But before I do, I'd just like to follow on a little bit about the things Pete and I spoke about. And clearly we see some headwinds, some challenges for our economy and our property markets. But we also see lots of, well, let's call them tailwinds, some things that to be looking forward to. I mean, to the untrained eye, it'd be easy to say, hey, this is no good. It's not the right time to invest. Interest rates are high. Maybe they won't go up that much anymore. Property values are still falling. And even if they have fallen, they're still unaffordable for most people. Oh, the government's regulating things, interfering, things scaring off property investors. Oh, look, there could be a recession. The banks could go broke. You'd be forgiven for wondering if this is the nail in the coffin for real estate. And clearly that's what some people are believing, because I know a lot of investors are getting out of the market, but this is not the end. While many investors and home buyers are sitting on the sidelines waiting for somebody to ring the bell saying the market's bottomed, I know strategic investors with a long-term view see this as the stage of the cycle that gives them a window of opportunity. Interestingly, we've never been as busy. Well, it's been a long, long time since we've been as busy with clients approaching us at Metropole to put strategic plans together for them to plan for the next stage of the cycle. They know that it's this stage of the cycle when fortunes were made in the past, but only for those who follow a proven strategy, because the statistics show that most in the past have not got the financial freedom they desire, and in my mind, it's going to be the same next time round as well. But if you believe that inflation is going to peak sometime this year, if you believe interest rates are going to peak sometime this year, even though the timing is uncertain, and you then recognise the market's going to reset and a new cycle will begin, then even though the timing of all this is uncertain, why not have a chat with my team at Metropole and let us explain to you our proven, time-tested strategy with a strong track record. We have frameworks that I've fine-tuned over 5 decades. Go to metropole.com.au, find out about how we can help you. By the way, we don't sell property, but we do help you outperform the averages safely in our property markets. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share a list of things with you that you'll regret in the future if you don't do now. Now, I talk a lot about money and property in these podcasts, but when you get to know me, you'll realise that I believe true wealth is what you're left with after they take all your money away. Sure, money is important in some aspects of your life, but it's not important in others. So these 12 things that I'm going to discuss with you, I think are just important as money and will help you enjoy the journey. If you don't enjoy the journey to your final destination, you're not going to enjoy the destination. So the first thing I'd like to remind you is to put your health and your wellness above everything else. Look, there's an old saying, if you don't have your health, you've got nothing. And this is very true, isn't it? Boys that have been brought home over the last year or two, what's the use of having all the money if you're in one of those countries at the moment where you're stuck indoors with COVID, or you're even worse, in hospital? The other lesson I'd like to show you is take time to do things you love. Now, I know it might sound cliche, but work a little bit less and play a little bit more. Now, I'm not saying don't work hard. You're not going to get anywhere if you don't work hard, but you're never going to regret taking a vacation or engaging in a new hobby or spending a day with those who make you happy, because there has to be a balance. There's always going to be more work to do, so balance your life and enjoy it. The third lesson I'd like to share with you along this theme is stop taking life so seriously. Why are you taking life so seriously anyway? Why are you worrying about all those things? Because remember, most of the things we worry about never happen, or if they do happen, they're not as serious as we thought they're going to be. And down the track, I don't know, in 2 years, in 2 days, they're not going to be as important as they seem to you today. So stop taking life so seriously. The fourth lesson I'd like to share with you is always say what you need to say. If you love somebody, tell them. If somebody hurt you, tell them. If you've got trouble expressing your feelings, sure, you can write a letter or write an email, but that's not the way to do it. Make sure those around you know each and every day how you feel. Another lesson I'd like to share with you is open your mind to possibilities. This is one of the things I share with people in my mentorship program, that they really should reach for the stars. And if they don't do it and only get to the moon, that's no problem. But there's always ways of doing things. Open your mind to possibilities. The sixth of the 12 little life lessons I'd like to share with you today is follow your own path. Live a life true to you. Stop comparing yourself to others. Stop striving for perfection. Stop living a life based on expectation of others. This has obviously been made worse by social media over the years, where everyone shows you what they bought for lunch, what they ate, what they dressed, all the things that look good, sound good, but you don't see all the stories behind it. I mean, look at Melinda and Bill Gates, who recently divorced, and everyone thought, gee, they were happy, and look at the billions of dollars they've got. So follow your own path, live a life that's true to you. The seventh lesson is stop living in the past. Right now you need to throw away the regrets of the past. It's gone. There's no point dwelling on what could have been. Doing so is only going to rob you of the present moment of joy. The past doesn't exist other than as a memory. It's a mental story and it can't be changed. So don't live in the past. What happened, happened. Move on to the future. Now, the eighth little lesson is accept things you can't change. I mean, there are some things you can't change. So rather than being upset by them, worrying about them, being concerned, work on the things you can change, things you've got control over, and don't get upset by the things you can't control. Accept things you can't change. Another of these little life messages, lessons I'd like to leave you with is practice mindful living. Mindful living will slow down time. It will enhance the present moment. It'll fill otherwise mundane days with awe and joy. So pay attention to what you're doing. When you're there, be there. In other words, if you're with your kids or your friends, don't have the phone on. Don't look at Instagram or Facebook. Practice mindful living. Another little hint is stop chasing money, fame and possessions. Now, we crave wealth. We want prestige. We want fame. We want popularity. We're normal. We're human. We crave material things and beautiful people. And we mistakenly think happiness is going to arrive when we get these goals. My suggestion to you is instead enjoy your life. If you're constantly in pursuit of something other than where you are right now, you're not going to be enjoying the experience. And at the end of the life, your expensive BMW won't be what's flashing in your mind. You'll more likely be smiling at the memory of, your loyal dog. So stop chasing material possessions. There's no real happiness there, only an endless pursuit. Now, don't get me wrong. I'm not saying you shouldn't be building an asset base to protect your future, but I'm suggesting put it all in perspective. The 11th lesson I'd like to remind you of is always practice gratitude. If you're not grateful, you won't ever be rich. We know all those rich people we've heard the stories of rich people who are miserable. They're sour. They don't appreciate what they've got. You're living in the best country in the world at the best time in history. Appreciate it. And the last of these 12 little things I'd like to talk to you about today that I believe are going to be important and you'll regret in the future if you don't concentrate on them today is the message of love. Pay attention to all the sources of love in your life. And you're going to develop a growing sense of abundance. You're going to see beauty around you each day. You're going to be optimistic rather than pessimistic. So there you have it. A list of 12 just little independent, random thoughts, a list of things that I think you'll regret in the future if you don't do them. them now. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?